In this video, traders, we are going to look at how do hedge funds generate alpha when they seem to have so many positions. Stay tuned. Hey guys, warm welcome to you. All right, so how do hedge funds generate alpha? Okay, it seems like they've got so many positions, right? Some of these hedge funds have got thousands and thousands of stock positions, and you would think that if they are that diversified, it's going to dilute any alpha they generate. Get a couple of bonus positions that shoot off to the moon. It's negated by the 998 that are just chugging along with the market. And so how do these guys generate alpha, and how do they decide which way to position or how to position to still be alive if something goes wrong, but also outperform so they encourage more funds to come in to the actual fund itself? Okay, so there's three things here to look at. When you're looking at hedge funds, there's a distinct difference actually. You know, we kind of put them in a big bracket, right? We say all hedge funds, but they are wildly different across the board. You've got all the way down to, let's say, someone like Winton Capital or one of those high frequency trading type firms that are literally there, and their edge is technology. They're using technology to trade many times a day, and they're not really hedge, even though they are a hedge fund per se. Someone will put capital, I don't know if they take external capital, I don't think they do, but they are still managing money in a way. But then look at that compared to all the other side of the coin, where you've got these really long-term kind of 20-year positions looking to mature. Even though they're broadly under some sort of kind of management structure that you could call a hedge fund, they're completely different. So the question really is, if they've got so many positions, how? So let's ignore the kind of technology side of stuff, the HFT, the algos, the predatory algos, all that kind of stuff. And let's think of people who are managers like you and I, who are deciding where to allocate capital. So the thing they will generally do is they will stick to a theme. Now this means that they can be diversified and have a number of stocks within that theme, but it's the theme that's going to outperform the market. So for example, they may well say, okay, is off the top of my head, they may say, okay, we believe that natural gas, or we believe that coal, or we believe that fossil fuels in general is probably the better word for it, like crude oil, natural gas, these type of things are going to see a resurgence over the next 10 years. For whatever reason, that might not be, you know, an accurate assessment, but that may be the theme. And so they would then go out and buy a broad section of stocks that have perhaps been beaten down because of the whole renewable energy thing, because of this, because of that. So they go out there, buy as many as they can, they kind of allocate capital to the ones they think will outperform. If that theme then works, then of course those stocks are going to outperform the rest of the market. That category of sector, if you like, or that theme of investment is going to outperform, and so they're going to generate alpha from that. So even though they have got quite a broad exposure, they're still focused and concentrated on one theme. So you can see how they can generate that alpha, as opposed to just being, you know, having a spread of, you know, across all the stocks and having multiple different themes. Like they've got some retail in there, they've got some renewable energy, they've got some fossil fuels, they've got some this, got some that. That would kind of replicate the market, right? S&P 500 or Russell 2000 or whatever it is. And so focusing on a theme, but then have multiple stocks within that theme would work very well for them. Okay, number two is strategies. So whilst there would be an investment theme, like, okay, we believe that this country is going to do well, or this country is going to do bad, or this, that, and then creating a structure and a lot of positions based around that. Strategy would be, okay, perhaps they trade a specific way after a specific event. So a lot of these funds are event driven. In other words, they see an event, maybe they see some kind of catalyst coming into the market, and they trade off that. Now, that could be stock specific, and of course that would generate alpha if they were correct, but it could also be some kind of event, let's say a politician, a new president, Brexit, something where there's a fundamental change in the theme of the way that perhaps a country is going to be governed or is going to be run, and then they will take a position based on that theme. So let's use Brexit as an example, right? They may say, okay, we think that this is going to boost this certain manufacturing sector abroad, and it's going to harm a certain sector in the UK, just off the top of my head. And so we will pair trade around that theme and that strategy. So that strategy is event driven based on the new idea we have coming into the market. We believe that these companies are going to do very well out of it. These companies are going to do very bad, and we're going to take a pair trade position on that, and that's event driven. almost event driven. I'm kind of loosely kind of packaging that. But that, and then again, you've got a broad kind of stock position on one side, broad stock position on the other, but you're generating alpha if that comes true. Similarly, you could say when Donald Trump became president, he was going to put a lot of money into infrastructure, and so event-driven would be, okay, loosely event-driven would be, okay, we think the infrastructure is going to benefit from it. Let's have a basket of stocks, 500 or so stocks that will benefit perhaps across the world. Okay, so concentrated positions. So this is interesting because the funds that generate the biggest alpha are the ones that go a lot deeper with the risk and take a lot more risk on concentrated positions. If you look at George Soros, when he made that huge bet on the pound, that wasn't spreading his risk all over a lot of stocks. That was like, okay, there's an opportunity here. I'm going to take a lot of risk on one specific bet and go in. And you would have people like Joel Greenblatt, who made multiple hundreds of percent over multiple years. I think we were doing like 40% a year or something like that. He would say, listen, I want 8 positions. I want 8 positions, and that was it. Or something like 6 to 8 positions. So the benefit of that, of course, is that you can generate serious alpha. You can seriously outperform. If all your chips are on a small number of positions and it works for you, you are going to be the hero, right? Your investors are going to want to put more money in. You're going to make a lot of money for yourself. It's going to be great. The downside, of course, is that if you get it wrong, you're going to seriously underperform the market. So there's a plus and minus of that. As with us and trading and investing ourselves, guys, you know if you're buying a kind of SPY ETF and holding that, or futures or whatever it may be, and you hold it, you're going to match the S&P 500, whatever it does. If you're trying to pick maybe a few tech stocks you think are going to outperform, or a few other stocks you think are going to outperform, if you're right, you might make 100% over a few year period. If you're wrong, those things may halve. And so that's the choice you've got to make as a hedge fund manager. And also, don't forget, as a hedge fund manager, that's what you are kind of displaying to investors, and often hedge funds will have a few different funds you can invest in. They'll say, hey, this is the high risk tech fund, if you like, and we pick 10 names and we rotate them frequently, and we do this and do that. This is the mining investment. We look for small cap miners that potentially might have a jackpot find, or oil exploration companies across the world that might have it, and that is a fund, and then you're investing in that theme or that idea. Or they might say, okay, this is like the slight outperform fund, if you like. That would be the worst marketing ever, right? Slight outperform. But this is a slight outperform where we have the majority of stocks have a majority of positions in an array of stocks, but we might go overweight on certain ones as well. It's like if we go back, I did a video on the 130 to 30, where you go overweight, you have 100% net in the market, you add another 30% long, and then you have a 30% short position as well. So you try and get a little bit of extra juice from the stocks that are outperforming, and a little bit of extra juice on the short side from the stocks that are underperforming. But that's how hedge funds generate alpha when they've got so many positions. It's a focused core on a specific theme or specific strategy. And this is kind of a loose extra thing, really. Concentrated positions are the key to big alpha, but also big risk. All right, guys, see you next one. Take care. Bye-bye.